statements. So if you didn't watch part 1, go back and watch it before we proceed. So the earlier part we looked at the income statement. So this part we are looking at the balance sheet. Balance sheet, stroke statement of financial position. Statement of financial position. Of financial. So what is the balance sheet? This one is just a statement that shows the company's assets, liabilities, and the equity. And it is derived from the accounting equation. So there are various ways of accounting equation, but specifically today we are going to use this. You know, one of the accounting equations states that assets equals to liabilities plus equity. So this is one of the format. This is in the business's assets must be equal to the liabilities and the equity. So you can get all the components from here. So if you look at the components of the financial position, components. 1, we have assets. Total assets. Total assets equals to current assets plus non-current assets. The total assets, the current assets, they are those ones that current assets, they stay in a business for a short period of time. The non-current, they stay in a business for a long period of time. The current assets can easily be converted into cash. For example, we mainly have 6 current assets. 1, cash. 2, bank. Cash, the amount of money you have in the business. Then the bank, your money in the bank. Then inventory. Usually it is closing inventory, goods at the end of the year. Then we have accounts receivable, stock debtors, accounts receivable, stock debtors. Then another current asset, we have prepaid expenses. And prepaid expenses are expenses that have been paid in advance. We shall look at it at the end of the adjustments. Then and lastly, we have accrued incomes. These are the 6 current assets that we have. So non-current assets. What are non-current assets? These ones stay long in the business. For example, furniture. Then we have motor vehicle, machinery, equipment, etc. So we get the total assets from the current plus the non-current. So then we are looking at equity, owner's equity. What is owner's equity? Equals to capital plus net profit minus drawings. What are drawings? This refers to money used by the owner of the business for personal use. Can be either in cash or in form of goods. So net profit we know, then capital plus net profit minus drawings. And lastly, liabilities. Liabilities are like loans. And we have both total liabilities equals to current liabilities plus non-current liabilities, stroke long-term liabilities. The current liabilities, these are short-term loans. For example, creditors, the one you expect to pay within a year. So we have creditors, we have prepaid incomes. You earn income earned in advance and accrued. Expenses, we have short-term loans. These are the common liabilities that we have. Then the non-current liabilities, we have long-term loans, debentures, etc. So this is all about the balance sheet, as easy as this. As long as you understand the assets, liabilities, and the equity. So it's simple. What are assets? What are liabilities? So we are going to the format now. Let's go to the format. The balance sheet. We have our details, shilling. So we begin with the non-current assets. So this is the cost, accumulated depreciation, net book value. This is the cost. So assuming we have machinery, you put the cost here, the net book value, so that and the net book value. So accumulated net book value equals to cost minus accumulated depreciation. Motor vehicle, cost. You may have land. Why do I put dash here? Land rarely depreciates. Land rarely depreciates. So this is the format. So you end up getting the total non-current assets. You put your total here. If you want, you can also add these ones. So that is the total non-current assets. So therefore you get the current. So you have your cash, you have your bank, you have your accounts receivable, you have your prepaid, maybe some other prepaid expenses. You have your accrued incomes, and you have your inventory, closing inventory. So the total, these are the non-current assets. These are the current assets. The total we get is what we call the total assets. So next. So remember, we said the assets, these are the total assets, must be equal to the liabilities. Must be equal to the liabilities from the equity. So therefore, we get the equity and the liabilities. So equity and liabilities. Then for equity equals to capital, you put it here. You add net profit if you have it. Then minus drawings. So lastly, you add the liabilities. It's better to begin